With a lot of stocks being down over 70% over the past few months, investors are obviously scared and are wondering what they should be doing with their portfolios. Should they be selling? Should they be holding on to it? Or should they even buy more? Today I want to talk you through a fictitious scenario of what happened to a growth stock portfolio over the next few months, just to see how your portfolio might play out in the future and how picking a couple of big winners might affect the entire balance and entire percentage return of your portfolio. But if you're new here, I'm Robert. Welcome to my channel. Here we look at stocks from an unbiased perspective, looking at the pros and cons, and always are focused on the long-term prospects of a company. Let's get into it. So I've got a fictitious portfolio here on the left side that is consisting of 10 stocks. And John, our investor, has made a few investments in 2020, 2021, built his portfolio out and has made a few investments into different types of companies, different sizes of companies, all different industries and areas. He's made an investment of $5,000 for each of his position. So he had a total of $50,000 to invest, or has invested a total of $50,000 over the past 2 years. And he made those investments in companies that you can see here, the market cap. So some of them are $2 trillion, some of them have $800 billion, some are in the $200 billion range, but also some smaller investments below $100 billion in the 50, 30, and then some of the smaller ones that are kind of new to the market, comparable to sort of like a SOFI or HIMS stock, where they were trading at a $6 billion market cap, and stock number 10 trading at a $5 billion market cap. And he, over the time of the last 2 years, basically invested $5,000 each at those price levels, at those market caps that we have here. And now we have him obviously freaking out since the market, since November 2021, has been just consistently falling, and all of his stocks that were mostly growth stocks have been hit really hard since the beginning of November, with interest rate fears, with other fears such as the war breaking out, and other recession fears now coming on board as well. So he had those types of stock getting into a situation that we have up here, where they are down massively from their all-time high. So he hasn't really bought anything more. He only built up the position until 5,000, and then he watched it basically going down and down. And here I made some assumptions that his stocks have been falling based on that percentage that I've given here. So the larger ones have fallen, less in comparison to the smaller cap ones, which is usually the case, as obviously the percentage is going to be bigger if the market cap is smaller. So the small market caps only need a $1 billion $1 billion drop to actually result in a 20-30% drawdown. So I've given them all a decline, just to be a bit pessimistic here in this scenario. I've given the biggest one, giving them a 35% decline. The 800 billion one, I've given them a 30% decline. And the ones below 100, I've given them a really aggressive decline from 60% all the way up to 80% drawdown at their peak. So his portfolio obviously got a huge hit, took a huge hit here, resulting in his current market portfolio, which we've got here. Basically all stocks being losers at the moment, losing him money. His original investments are all less than before that, as given the decline that we have here at the moment. The market caps have come down significantly to only $1 billion for the smallest position, and from the biggest position, which was starting at a $2 trillion, is only trading at a $1.3 trillion market cap, which is comparable to an Amazon, for instance, or Facebook, which has dropped below $1 billion market cap. A HIMS, for instance, that was trading at a multiple of almost $10 billion, now trading at below $1 billion. So he has made this, this is his portfolio at the moment. So he's looking at the number, he's seeing that his original $50,000 is now worth only $23,500. Overall portfolio is down 53%. So obviously not a good position to be in. He's obviously going to be depressed. He's quite new to the market. He's questioning himself whether he's done everything right, and now he's thinking about selling. But now we're going to look at, let's say he can control himself. Let's say he's reading a lot of books, he's reading a lot of seeing a lot of videos, reading articles about how the investor mind should be set up. He can control himself, and he will just not invest anymore, but he will also not touch anything. He won't sell anything. So now we're going to look at the third portfolio, the actual, future projection of his portfolio, to see what might be potential outcomes if in a situation like this, at least a few of those are really, really good future bulletproof companies that will outperform the market. How would your portfolio how might your portfolio look in the future if you just hold on to it and you don't do it anything else? You're not freaking out. So we have the future portfolio here. So what I've done actually, so I've given it kind of a mix. We want to be realistic. Not all of the stocks you are taking, not all of the stocks you are choosing are going to be winners in the long term. You have to be aware of that. So what you're doing is, if you have a portfolio of 10 stocks, you're actually just picking based on an educated guess. You've done all your due diligence. You've decided that those 10 are your top 10 that you see in the market out there, the top 10 that you like most with the best future potential in your point of view, and you placed your bets. It's basically like betting on a horse, but more from a financial, more like educated. It's not pure gambling, because obviously you can look at numbers, you can analyze management, you can analyze the market and so on. But still, at the end of the day, you don't know what's going to happen, and all you made is an educated bet based on the information that was provided to you on those 10 companies. So this is all we're doing when we're investing. And you just have to hope for that at least 2 or 3 of them play out really, really well, as we're going to see very shortly, for you to make a long-term profit with this types of investing. So I've given the future portfolio, I've actually reversed the loss for the first one, and if you see that here, I've reversed so originally it was at $2 trillion, and then at 800, 500, and 250, and I've basically said, well, the first one is just back to his original level, so we're back at the 5,000. And then the other ones, I've made them, slight losers. So here we've lost like over $1,000. We lost $1,000. We lost $2,000 on the other 3. Then on the fourth one or fifth one, I've actually made it a winner. Made this a winner as well. And then what I've done on the small caps, I made them actually go, double up and even triple up over time. And one of the medium caps that was sitting at a $50 billion cap, I made them go up to $100 billion. So basically doubling up that investment. And this could be, a realistic portfolio for 5-year time horizons. You will have picked a few winners that will massively outperform the market. But obviously you will also have picked a few losers that, over the time period of that. So, and what we're seeing here at the moment is, even though I haven't made any significant or any crazy assumptions for that, you still are looking at a 205% gain for the next 5 years. Your portfolio is sitting at a $72,000, which at the lowest low, which is right now, is sitting only at 23,000. You started off with 50,000. You can see here is basically you still made $72,000 in total compared to the lowest of the lowest, 23,000 when everything was down, and your original investment of 50,000. And I haven't even let any of those play out like in a massive way. I haven't like 10x any of those. So the biggest increase we have here is a triple from that one that we've invested 5,000 as well, which is now 15,000, and a double up here for one of the medium caps. So, and then what you see is from the lowest of the lowest, we've got a 200% return, annualized return over 5 years, 40%. And from your initial investment, we still get a 44% return overall, annual return over 9%, which is pretty much like a average annual return that you get in the stock market out there. So even though you didn't buy the dip and you hold on to it, and the scenario didn't even play out very well, and you have a lot of positions that are just remaining around the same or even a little less than what you've put in, you're still making an average market return. And then obviously what it's also showing us is, if you are sure on those companies, if you've made your due diligence and you're really convinced about that, and you have high conviction for a lot of those, you should keep buying in those dips, because obviously the return from the lowest of the lows to your new current portfolio is 200%, annualized return 40%. So that means if you have money and your stock is down 60-70% and you are pretty sure that this stock is going to be 5 to 10x in the next few years, you should be heavily buying the dip on those, because obviously if a stock is $10 and it doubles up to $20 because the valuation was already high, then this is a 2x, which is nice. But let's say the stock dropped from $10 to $2 and then it still goes to 20 over time because your original estimate still holds true and the stock goes to $20, then your investment just 10x and not just 2x. So it's really important, especially for the smaller ones, to buy them at the lowest possible price for the highest potential upside when that goes back up. So you really make with those smaller stocks, you really make 2, 3, 4x very quickly. And this is, like, as I said, not really a super optimistic portfolio. If I can actually say, well, one of them goes back up to $1 trillion and your small position, which was obviously sitting at a $5 originally, let's say it really outperforms, it becomes a market leader in its space, and over the next 5 years, it just 10x's, because that's what management execution has done, and it's really just been executing well, making a huge profit, turning profitable, and keep growing the top line. Then you got a big winner here, which obviously affects your entire portfolio balance. So one outstanding winner can make up for any of these other losers that you have here. Even if I pull this one back down and I say, well, no, it's actually just gonna be 800 billion, you're still looking at a return overall from your initial balance of 116%, annualized return of 23%, which if you can compound this over time, it's going to be massive. It's going to be a massive difference. And then from the lowest, obviously a huge return there, 360%, annualized return 72%. So this was with a 10x here. And even if you go with the lowest values that we had over here, and you say that none of them is going to come back, only your 10x winner is going to stay, which is the smallest company. It's just basically 1 out of 10 is a 10x, and all of these others are losers, down more than 30 to 60%, and then just stay down. Your portfolio is still up. You still made an initial return of 45% and annualized return over 9%, which is the average of the stock market. You still made a tremendous return, and you're still basically in line with the index performance, even though everything else is a loser, which is pretty unrealistic. If you've made your due diligence and if you actually made your proper research, it's highly likely that at least more than half of them are going to be more worth now later than what they're worth now. And especially at times when there's a huge drawdown that we see in the market, when there's extreme fear, you should be really greedy and pile up on your high conviction stocks, on your top 10, for them to actually outperform even better. Because if you like that stock at $20, you would absolutely love it at $10, obviously. So yeah, this was just a quick lesson to see how a portfolio that is actually heavily down at the moment, if you just pick the right winners, if you just pick a couple of really good winners and future good companies, that actually it doesn't really matter. It doesn't really matter that it's 50% down, as you will outperform in the future, and you just have to have patience and actually buy heavily in those dips. So yeah, hope you enjoyed this video. Let me know what companies are in your top 10. What are you heavily buying on at the moment? What is dipping more than 60% and you are buying on? Yeah, let me know, and see you next time. Bye.